So this is the revision video for topic area 5.2 based around risk and certainty. The topic looks at business success initially, then business failure and the causes of failure. Then it looks at problems which the economy might face, the importance of exchange rates, and then the government's role in solving social and economic problems through policy. So how can success be measured? Chapter 1. Firstly, profit is a key measure of success for businesses, isn't it? Formula for profit being total revenue minus total cost. Shareholders have profit as their primary objective. But profit margins are also very important to consider, particularly for the management of the organisation. So that difference between the price that you can charge and the cost per unit. Profit as a proportion of revenue. Other measures, market share. This is to do with revenue really, or your proportion of revenue compared to the size, the overall size of the market by revenue. So if you look on the right hand side, you've got the UK supermarket market share, Asda with 17%. That means they have 17% of the overall revenue in that market. So their revenue accounts for 17% of the overall sales in the market, whereas 29% of those sales are Tesco's. So a key measure of success for many businesses. Social success considers social and ethical factors really, and the general behaviour of the organisation. So for example, a clothing retailer and their decision to produce or have textiles products manufactured abroad, there'd be issues surrounding that they would have to consider from an ethical point of view. And the final one, the environment, very important for all businesses these days to consider their impact on the environment and how they can reduce it so they can measure their performance based around that. Next topic area is causes of business failure. When firms fail, they basically have not earned enough revenue to cover the costs. If that happens over a long period of time, they become what we call insolvent, which simply means that they're unable to pay their daily bills. Businesses in the short term can make a loss. They can have short-term problems. It's when that persists over a long period that ultimately the business will fail. So this is obviously linked strongly to cash flow concept from Unit 1 of the course. Little diagram there, causes of failure that you need to know and remember. So it could be marketing mix issues. You could have got your price wrong. Could have got the promotion aspect wrong, which causes a reduction in sales. Price is too high, sales are too low, revenue too low, problems. The product itself could be defective or of low quality. You might have poor cash flow management, so it might be an issue from a management point of view. You've held too much stock, increases your cash outflows. So your cash outflows are greater than your inflows over time. Unfortunately, you're going to fail as a business. It might be that you are an inefficient business. Your costs per unit are too high. You're unable to keep your prices low enough to compete because your costs are so high compared to your rivals. Demand might be changing. Income obviously is a big factor that influences the demand for products and therefore revenue, so you might be susceptible to that. It might be to do with tastes and fashion. You're just not keeping up with the market and changes within that market about what people like and want to buy, particularly important in, say, the fashion industry. Chapter 3 looks at the problems that the economy faces. The key problems that are outlined in your textbook are to do with changing demand or economic activity. To define economic activity, it's the amount of buying and selling of goods and services. So how many goods and services are being bought and sold over time? And that is a measure or an influence on the overall level of demand for goods and services in the economy. Lots of factors influence the level of demand in the economy. Interest rates set by the Bank of England, consumer and business confidence, foreign demand for our goods and services, might be taxes that the government set. Inflation, another problem. So to define it, it's the average rise in the price level of goods and services, and it's measured by the Consumer Price Index, or the CPI. If inflation, or the prices of goods and services, are rising at a greater rate than your income, you are less able to afford goods and services. So inflation has a big impact on business confidence, expectations. If prices are fluctuating, they're going up and down or wherever, you don't really know what's happening. It's difficult for a firm to plan ahead and invest. So it reduces investment spending, creates uncertainty, as well as reducing living standards because the cost of living rises if your wages aren't going up at the same rate. Very important point. You could use that as an evaluative point in a more extended writing response. Inflation also raises costs of production for firms. This is one of the causes of inflation, cost push inflation. Firms increase prices to compensate. So inflation is caused by either demand in the economy outstripping supply, so we call that demand pull inflation. So where demand for goods and services is rising so fast that firms see that as an incentive to maximize their profits and they raise price. Or the other cause is to do with cost of production increasing, which means firms pass on that increase in their costs in the form of higher prices to compensate. That's known as cost push inflation. Arguably more dangerous, more worrying than demand pull. Because with demand pull inflation, usually the economy is performing quite well, unemployment's quite low, there's economic growth. Cost push inflation usually is more problematic because you might not be having that increase in demand. It can actually lead to firms cutting costs, and one of the ways they'll do that is by laying workers off. There's also this issue of what we call the wage price spiral. So if inflation increases quite quickly, it can actually lead to more inflation. And that's because employees will often approach their employer to demand higher wages. The effect of that is it will increase costs for firms, who will then decide to raise prices even further, which causes more inflation. That effect keeps going round and round and round, hence the name wage price spiral. Another problem that economies face are external or internal shocks. So these are unanticipated events from either within the economy or outside. They're unanticipated. Firms don't like that. The government doesn't like that. Consumers doesn't like it. It's a shock to the economy. So just going back to the external and internal shocks bit, that could come from, for example, a catastrophic natural disaster somewhere in the world. It might be a big recession in one of your trading partners. It could be a political event from within your economy, or an unexpected policy change like increased taxes, for example. Unemployment is the other big problem. So it's when people who want to work can't find a job. There's two measures of unemployment: the claimant count and the labour force survey. Claimant count is simply the number of people claiming job seekers allowance or unemployment benefits. The labour force survey is a survey which is sent out to households to assess their employment circumstances. Two slightly different measures with slightly different numbers in the end, because the claimant count is actually more of a harsh measure of unemployment, so fewer people are measured to be unemployed by the claimant count than the labour force survey, because it's quite difficult in some circumstances to claim benefits. You need to know the costs of unemployment to the individual and to society as a whole. So to the individual person who is unemployed, things like lower standard of living, loss of self-esteem, loss of skills because you're not in work, and potential for family breakup. Cost to society, the tax revenue for government falls. That's because people are not working. Therefore, they're not paying income tax. They're not buying goods and paying VAT. The government has to pay more benefits to these people, which is an opportunity cost for government, really, isn't it? Because they then have not got the same level of money to be able to spend on other things that they would like to, like the health service or education. There might be increased crime in certain areas and potentially falling demand for goods and services, which could cause, in the worst case scenario, a recession. You need to remember that table. So how important are exchange rates? Very, the answer. To define exchange rates, it's the value of one currency in terms of another. And they are determined, the value of a currency is determined simply by the demand for it and the supply of it on the foreign exchange markets. We say exchange rates can either strengthen or weaken. And a very important acronym to remember is the SPICED concept: strong pound, imports cheaper, exports dearer. If you get a question on exchange rates, write that on the paper and remember it. When the exchange rate weakens, it means that more pounds are required to purchase a given foreign currency. So at the moment, the pound has weakened against the dollar and the euro. The pound, a single unit of a pound, £1 will buy you fewer dollars and euros than it would 2 years ago. When the exchange rate strengthens, it's the opposite effect. Fewer pounds have to be exchanged for a foreign currency. There's no right or wrong with exchange rates. The impact all depends on whether you're an importer or you're an exporter. So some numerical examples there with impact on business and impact on consumers. So when the pound becomes stronger as an importing business, if you buy goods or raw materials from abroad, you'll find it cheaper. That means it lowers your cost of production. You might then be able to lower your prices for consumers. Not necessarily a bad thing. Exporters, however, find it more difficult to sell abroad because their goods appear more expensive to foreign buyers. Consumers, well, if firms do lower their prices because of cheaper imports, they benefit from that. Exporting firms might struggle though. They might end up having to lay off workers because their income falls. If you're a tourist, you'd find it much cheaper to travel abroad. If the pound weakens, so for example like it has done at the moment against the dollar and the euro, exporting firms should see a rise in demand for their goods because they appear cheaper to foreign buyers. Importing businesses find that things are costing more because the pound will buy fewer units of the foreign currency. So cost of production might rise. Problem with this, jobs may be lost as firms decide to cut costs elsewhere. Or they also might increase prices, so consumers might end up paying more for goods and services. Inflation may rise. We are seeing a little bit of this in the UK economy at the moment. Jobs may be created in export-based sectors though, which offsets the problem. And if you were a tourist, you'd find it much more expensive if you were to travel abroad. So some key evaluative points to remember based around exchange rates and their impact. Not all firms are affected in the same way. Very much depends on how much you rely on imports and exports. And exchange rate movements are often temporary. Finally, on this section, what can the government do to solve economic and social problems? Well, the government can use two policy tools, either what we call fiscal policy, which is to do with taxation decisions and spending decisions. So how the taxation is a form of revenue for government. It's how they earn money. Income tax, VAT, national insurance, they're all taxes. Corporation tax on business. Government earns a lot of money from that. And then they spend that money in order to help achieve their objectives. Monetary policy is not the government, it's the Bank of England, our central bank, who manipulate interest rates and control the money supply to influence economic activity and inflation. Monetary policy's main aim is to do with inflation. So to remember, monetary policy is about interest rates, and interest rates are the cost of borrowing money and the incentive to save that money. If you remember those 2 points, any question that comes up about interest rates where you have to explain or analyse or come to a judgment, you'll be fine, okay? The cost of borrowing and the incentive to save, very important. Economic problems that we've come up against, so inflation. How do we use monetary policy? Well, we can increase interest rates. That means the cost of borrowing rises, which lowers the demand in the economy. Fewer loans are taken out, less business investment spending, less consumer spending. which lowers inflation rates, reduces demand pull inflation. You could use fiscal policy, increase taxes, reduce government spending. Again, that lowers demand, which lowers demand pull inflation. There are consequences to these though. Obviously, if you're lowering demand in the economy, that will potentially increase unemployment rates and reduce economic growth. So it's not always desirable. There's often trade-offs that exist. Unemployment, monetary policy again. If you reduce interest rates, it stimulates economic activity. Remember we said labour is what we call a derived demand. The demand for workers is derived from the demand for goods and services. So if the demand for goods goes up, that means the demand for workers goes up, and vice versa. So low interest rates means it's cheaper to borrow and the incentive to save is less. This means there's more borrowing and spending and there's less people saving money, which by definition means more likely to be spending. Changing demand, again, you can use monetary and fiscal policy for that. Some social problems that we can deal with now. Child poverty. Well, fiscal policy can be used. You could increase benefit payments to low-income families. You could reduce tax rates for low-income individuals and families to provide more of an incentive to work, because people will now be able to keep more of their extra income that they earn. Crime. Fiscal policy. Increase spending to create jobs. Provide opportunities within communities. Improve education. Antisocial behaviour. Again, increase spending on education. People are more likely to get a job, less likely to be causing antisocial problems on the streets, and potentially raise taxes on products which might fuel antisocial behaviour, such as alcohol. So you need to know how these policies work, potential drawbacks of the policies, and how they can be used to help solve social and economic problems. Obviously, this topic lends itself to a more 8-marker, 6-marker, 10-marker extended writing question. So arguments for, against, judgment, in context with balance. Very important to remember. So is tax effective overall? Well, can be, because it often will raise prices, which helps reduce demand. Although, it's a really important depend-on point, the effect of this depends on the price sensitivity of demand. Increased spending on education is often more effective, but it's a long-term option. And remember, every time the government chooses to spend, there's an opportunity cost. They haven't got unlimited resources. They're not able to spend on everything. They already spend more than what they earn in tax revenue, so it's difficult to increase spending further. Often it might mean tax rises elsewhere, which have negative effects on economic growth.